All right, welcome everyone. Thank you for attending. This is how to master the art of multifamily investing. So this webinar, it's really intended to be a comprehensive introduction to multifamily investing with a particular focus on the advantages of passive investments. So syndications and things like that will be our particular focus, but I think anybody that's investing in any type of real estate could get some value out of this. So if you're just starting out in multifamily or you've never invested in real estate and you're curious and you want to learn more, this is really the perfect place to start because I'll be diving into the fundamentals behind multifamily investing and show why it's really the preferred asset class of the wealthy and why it's become so popular over especially the last decade. All right, quick disclaimer. So I'm not an investment advisor. This presentation is provided for educational entertainment purposes. This isn't specific investment advice. So please don't make any financial decisions based off it. Always consult with your own consiglieres if you have an attorney, an accountant, or a financial advisor. Please consult with them before making any financial decision. All right, a bit about myself. I know there's a lot of people on the call this is their first introduction to me. So I just want to tell you a little bit about myself, where I'm from, how I came to be here. So I grew up north of Boston, originally from the north of Boston area, born and raised there. Went to school in a small state school in Massachusetts, and I had a ROTC scholarship out of high school. So that led me into the path of a military career. So out of college, I went right into the Air Force as a lieutenant. I had an aviation track. So I went and started my initial flight training down in Pensacola, Florida. And I ended up tracking B-1s, the B-1 bomber. So I was a navigator on that for my career. And that career took me to Rapid City, South Dakota, which is, I wanted to bring it up because that is where I bought my first investment property. So that's kind of where things all started for me. And at the time, I didn't know anything about real estate or investing. It was all just kind of common sense decision making, did some back of the napkin math on what I thought my income and expenses might be. And ultimately it all worked out great. And after a couple of years of owning and managing that duplex where I also lived, so I was house hacking, a couple of years later, I went and bought another one, and then a couple of years bought another one, and so on. So by the time I decided to get out of the Air Force, because I decided that wasn't a career I wanted to pursue through 20 years and retire out of the military, I decided I wanted to get out and do my own thing. And I had this nice little portfolio of cash flowing real estate. So at the time, I didn't know I was going to pursue real estate full time, but I knew I had these investments that were a great decision, especially when I got out and I realized, hey, I still have income coming in from these previous investments. So I started to really see the power of real estate at that point. But like I said, I didn't know I was going to pursue it full time. I was kind of going in different directions. I initially just took some time off to decompress and kind of travel around the world a bit and see some cool places. And I was looking at possibly going to grad school. I was looking at some business ideas, and then cryptocurrency exploded shortly at this time. And I had made some early investments, particularly in Bitcoin, back in like 2013. So that meant suddenly my net worth was a lot higher, and just kind of gave me some added flexibility to pursue what I wanted. And I really found myself thinking about this little portfolio and realized I actually enjoyed it. I liked being a landlord. I liked the satisfaction that you'd get from turning a unit, signing a new lease, and just kind of started thinking, well, how do people do this for a living, right? So that is what kickstarted my career in real estate. And I started attending a lot of live events, meetups, things like that, conferences, and networking a lot and getting to know different people within the industry. And pretty soon I was co-hosting my own meetup. And that's how I found my way into the world of syndication. And, I really found a passion for real estate. I had these opportunities to present at these real estate meetups and share what I learned over the last few years with others. Because the more I learned about real estate, the more convinced I became, especially for the average person out there. I think real estate is the number one path to building wealth and achieving financial freedom. So if that's what you're interested in, let's talk about that. So why invest in real estate? Why are so many people clamoring to invest in real estate, multifamily real estate? Why has that become kind of the darling of the investment community with trillions of dollars invested? Literally trillions of dollars are invested in multifamily across the country, in the world. So how can we be a part of that? So we're going to talk about that. We're going to talk about the greatest risk to investors and why you simply can't afford to ignore that risk. We'll go over some of the concepts and strategies that investors use in and basically how we make money in real estate. So we'll give an intro to multifamily there. We'll talk about some of what is driving demand from a macro level, a long-term perspective, what is driving demand that's going to ensure that this is a healthy quality investment for a long time to come, how it earned its reputation for stability and dependability, and then just some of the top reasons to invest in real estate. What are the benefits of owning multifamily? What do you get out of it? And then we'll talk briefly about kind of the general life cycle of a deal. And that's what we're going to talk about today. So let's circle back to the why. So why real estate? What's wrong with stocks and bonds, right? Well, long story short, they just don't produce enough yield. You're just not going to get the yield that you need out of stocks and bonds. And I'll prove that to you in subsequent slides with the actual numbers, right? But let's just talk about that. I mean, you look at the stock market, most people are going to say expect 8 to 10% returns out of the stock market, right? 8 to 10%. Hey, and that's reasonable. And that's a healthy return, but it's not enough. It's not enough. You need more. Need, not want, need. And bonds are just completely useless at this point. There was a time where it made sense to hold a certain percentage of your portfolio in bonds. And especially, the prevailing kind of consensus was that as you move towards retirement age, you'd put more and more of your money into bonds to preserve your capital. But right now we're at, a 0% interest rate. There's really no developed countries above 0%. In fact, there's some countries overseas that have negative interest rates. So it actually costs money to lend money to, like the German government. You actually have to pay them to lend the money, which is insane. So bonds are essentially useless if you're looking to grow wealth. And that's, trillions of dollars of bonds that aren't performing out there. So really, bottom line, you got to think beyond stocks and bonds, and you need to chase higher yields. And why do we need higher yields? Because we've been sold this lie that the key to investing for retirement is to avoid all risks at all costs. And the least risk is in index funds and mutual funds and other financial products. That's what they are. They're financial products that Wall Street and the financial industry sells us so that they can collect fees on your investment, right? And if you think about the design of the American kind of retirement system, if you will, it's really designed to keep your money locked up in Wall Street for decades so that they can play with it and continue to churn it and make money, right? So the big banks are profiting trillions of dollars off of your IRAs, 401ks, TSPs, et cetera, because that's what this system was designed to do. It's designed by bankers for bankers. And, okay, there's tax advantages to some of those accounts for sure. It certainly has a place in a portfolio. There's a lot of truth to that. But in general, I think, the discussion in America tends to gloss over a lot of the disadvantages that are inherent to that system. And the crux of it is it doesn't give you control over your own money. It's your money. You earned it. So why are you penalized for trying to access it? If you have a life event and you need liquidity, you need some cash, you have to pay a penalty to access your own money. It doesn't make sense. These are things that we've just sort of accepted as just the way things are. But when you take a step back and you realize it doesn't really make a lot of sense, and investing outside of those products is really not as risky as we're led to believe. I mean, you try to get your money out of Fidelity or someone, they're going to tell you how you're going to lose all your money and it's super risky, and don't go self-directed. Don't put your money in anything but, the Vanguard, VT Sachs, or, the Spartan Fund or whatever it is, right? But really taking that leap is not that risky. In fact, not taking that leap is the true risk. Not putting your money into higher yield assets is the biggest risk you can take in planning for your retirement. So how can we do this? How can we do it passively as well? Because the fact of the matter is there's many people out there that simply aren't interested in becoming a landlord, or maybe they're just not cut out for it. And that's fine too, because it does take a certain, je ne sais quoi, I guess, to be a landlord, a lot of patience, and there's a lot of work that goes into it. There's a fair amount of work that goes into landlording. Frankly, it's a lot of bullshit you got to put up with, right? I mean, that's just true. That's just an undeniable fact that if you own real estate and you're actively involved, you're going to deal with some bullshit. And a lot of people, they don't have time for that. They don't have the time, the inclination, or the patience for that, but they still want outsized returns. So they want to invest passively in real estate. And I think that is very powerful once people start to understand that they can get out of that kind of traditional method of just putting money into mutual funds and actually start putting their money into assets that make more sense for them. When we ask the question of why we need to invest in real estate, there's many ways to answer that question, but I think this is the center of it. Ultimately, it comes down to how do we properly plan and prepare for retirement? And as I said, there's a general consensus on what's needed and how to get it. But the problem is that whole system is built on a lie, right? If we want to be generous, we could say it's a system that was built for a world that no longer exists, right? Because it used to be that you could do that. You could just put your money into a mutual fund and save up over years and you'd be fine, right? But that world the math is right, but the assumptions are wrong. And one of the major assumptions is how long we're going to spend in retirement. So if you plan on living for 20 years in retirement and your retirement plan is based off that, well, what happens if you end up living 30 years in retirement or 40 years? You're going to have a bad time, right? It's not going to go well. You better hope there's someone there to save your ass if you run out of money, right? Because America's Social Security and retirement planning system was just designed for this different reality. And a big part of that is that people just didn't live as long back then. So if we go back over the last 100 years, we look at expected lifespan, look at the early 1900s, 49 years was the expected lifespan. So you'd basically just work until you died. There wasn't really retirement planning. Just wasn't really a thing. Right? Fast forward to 1960 and life expectancy was up considerably to 69 years. Now, this was after Social Security was put in place, which was designed to provide some relief in those few years that you're alive post-retirement. But we have to remember that Social Security went a lot farther back then compared to now and just hasn't kept up with the cost of living. So bottom line is, even in the 60s, you only needed money to last a few years and to supplement your Social Security, which went a lot farther. So you really didn't need that much money. Fast forward to today, it's obviously a much different picture. So life expectancy is 79 years and rising. And we can only expect with modern medicine and technology, as that continues to improve and innovate, that your time spent in retirement is going to increase. So instead of in the 60s spending a few years in retirement, now we're spending a few decades in retirement. So with that evolution, we also need to evolve our retirement planning approach, as well as the amount of money we'll need in retirement, which has now grown exponentially. And one of the big factors in retirement related expenses is healthcare. So healthcare costs have risen at a far greater pace than inflation, for sure, and really anything else. Probably the fastest growing expense that any individual will face in their lifetime. And it's the greatest threat to retirees' financial health. In fact, it's one of the leading causes of bankruptcy. And the fact is, when you get older, you need more medical care to the tune of 6 to 7 times the rate of when you're a healthy middle-aged person. You might go once a year to the doctor. When you're older, you might be there 7-8 times a year. So we need to be prepared for that as well. And as you can see, wage growth has only grown 16% in the same period that health expenditures have grown by 818%. So, that's like a 51x over wages. So this is why it's so important to think outside the box and seek those higher yields. As I said, most people are relying on the stock market, but let's actually look at the stock market and what it returns, right? So as we look at the stock market, we begin to understand that there's this fallacy at play here. We've seen, let's just look at the last year at what's taken place, these massive global changing pandemic. We've seen incredible volatility over the last year, but more importantly, kind of the irrationality of the markets during that period. So unemployment pushed into levels that we hadn't seen since the Great Depression, and yet the market basically ignored that, continued to rise in spite of it, and basically just diverged from reality. And if it can go up on irrational exuberance, then it can just as easily go down. And, a lot of it was being propped up by the quantitative easing and the money printing that was going on as well, which should be concerning for all of us, which we're going to talk about inflation right now, because at the end of the day, the proof is in the pudding. So here we can see the returns that we would expect aren't quite what we think they are. So this is, if you invested $1 in January 1st, 2000, after 20 years, your dollar grows to, adjusted for inflation, $2.47. So that's an annualized return of 4.4%. So that's not going to cut it, right? So this is 20 years of of S&P 500 data adjusted for inflation. So you can see once you adjust for inflation, stock market returns are weak and inflation kills your returns. And the bottom line is right now we're entering into, for the first time in decades, a period of high inflation. So this is more relevant today than it was even a year ago when I gave this presentation. Or, people have been talking about the benefits of real estate for hedging inflation forever, but I think it's never been more relevant than right now, since we're actually seeing it in real time. If we look at a period of high inflation, so back in the 70s, there was this period of high inflation. So from 73 to 81, $1 grew to 71 cents. So as you can see, the market didn't perform too well during this period, and you would have actually lost about 30 cents on the dollar. So I don't have a crystal ball. I can't predict the future. Maybe the market will continue to rise with all the quantitative easing and everything. But the last time we had high inflation, it didn't do so good. And I can tell you that last month inflation was 5.4%. Think about that. Now, the Fed will tell you that this inflation is transitory and they're not adjusting their policy in response to it. And that may be all well and good. It may be transitory. But what does that mean? Is that a year of these high inflation rates? If it's only a year or two, but your dollar's devalued by 10, 15%, does it matter if it was transitory? You still lost 10, 15%, right? So you need to make sure that you're chasing high yield. Otherwise, you're just losing money. So if we want to do better, we need to understand the importance of compound interest and why it's so important to seek those higher yields. And the compound effect really drives that home. So we're going to look at this. It's insanely powerful. Let's just take a look here. So if you invest $100 over 30 years, at different levels of return, what do you end up with? So we can see that at a 2% rate of return, your $100 turns into $182. Not cutting it, okay? It's not getting you very far, okay? You're basically losing money at today's inflation rate. So that can't happen, right? Now, you're saying, okay, well, I'm in the stock market, I'm expecting 8 to 10%. So if you invest $100 at 10%, it's going to grow to a little less than $2,000. Okay, that's decent. It's about a 20x. So it's something. You're getting somewhere. You've grown your money. But look what happens when you just go up to 18%. Now your $100 grew to over $21,000. That's a big leap from that 10 to 18%. And that's because of that exponential growth. Okay. So that's why it's so important to seek those higher yield returns. Even if all your, maybe you invest in 10 different properties, maybe they all don't achieve 18%. You might have some that only achieve 10%. That's fine, as long as your portfolio as a whole is doing those double-digit returns, because ultimately that's what you need. So let's look at it again, but let's start at the end goal and work backwards. I think will really drive this home. So in order to have $15,000 per month in passive income 20 years from now, so imagine you're 45 and you're just starting your retirement savings and investing now, you want to retire at 65, how much do you need to save every month to have 15 grand a month? Now, some might think $15,000 a month is a lot. And the fact of the matter is in 20 years, especially with today's inflation, that's going to be more like $6,000. So you have to keep that in mind. You have to keep it in mind, the effect of inflation by the time you get to your retirement, right? So a lot of people miss that. I see it all the time on, personal finance forums and retirement forums. People post their goals for retirement. I'm going to save until I have $1 million and I'll be good because I can pull out, $50,000 a year to live off of. And they don't take into account that $50,000 a year, 20 years from now is not going to be what it is today, right? So you have to keep that in mind. So at 2%, you're saving $30,000 a month. That's not happening. If you're able to save $30,000 a month, you're in the wrong place. Get off my webinar. All right. I'm not talking to you. This is, you're beyond this, right? So 2%, obviously, as we've established, not cutting it. Now 10%, you need to save $2,300 a month and change. That's achievable for a lot of people. Sure. You could save, what's that? 28,000 bucks a year. Yeah, a lot of people could save that. But look what happens when you go up to 18%, you only have to save $433 per month if you're investing at 18%. So this is why I say this is the best path to build wealth for the average person, because really no matter what your income level, as long as you're earning a comfortable kind of middle class income, you don't even have to be earning six figures. Most people can scrounge up $433 a month to put away. And if you're putting that into something that is high yield, you're going to see that outsized return down the line. But Keegan, higher return investments are riskier. They're so risky. Well, let's take a look at that. Let's talk about risk. So the mantra that's preached is high returns equal high risk, right? But the numbers don't always support that theory. So in particular, when we're talking about real estate, it's really, in my mind, a low risk investment in general. I mean, sure, there's always going to be anecdotes of people that lost everything on some deal that went sideways, and that's because real estate is very localized and niche, and mistakes can be made, right? So sure, there's always going to be deals that go sideways, but in general, on the whole, on the macro level, it's pretty low risk. So in fact, if we look at this chart, this is comparing down years to up years, looking at 75, 80 years or so. We can see that comparing real estate to stocks have like 3 times as many down years as real estate. So it's about, about 1 in 3, 1 in 3.5 years in the stock market will be red compared to 1 in 7 or 8 for maybe 1 in 10 for real estate. So overall, if we're looking at the past 80 years, real estate outperforms in terms of up years and down years. Another way to look at it, this is something that was published called the Sharpe ratio. And what this does is it compares the average annualized return of various asset classes to the annualized risk, adjusting for the standard deviation. So as you can see, real estate in the top left, that puts it in the lowest risk category with the highest returns on the chart. So the claim that real estate is high risk is really a fallacy. That's why I call it the risk fallacy. So what's the answer? Well, of course, as I've been saying, for most people, the best opportunity to build wealth and prepare for retirement is real estate. So whether you're investing on your own as a owner-operator, or if you want to avoid the hassles altogether, invest with a professional, with a syndicator such as myself or a developer or someone that's doing their own deals, it's generally a superior way to build wealth. And it doesn't have to be real estate. I think it could be anything with outsized returns that you should be seeking. I have a friend, Michael Nerby, he invests in laundromats. He buys laundromats, he renovates them, fixes them up, rebrands them, increases the cash flow. He makes a killing, makes like 20, 25% cash on cash on these laundromats. And yeah, it's a great business to be in. It's more like a business than real estate, but there's a real estate component often if you're buying the underlying building. So that could be an option. But for many, if you're here, you're probably more interested in multifamily. So let's define multifamily, because I talked early on about, my duplexes. So is that multifamily? 4 units, is that multifamily? For the purposes of this discussion going forward, I'll define multifamily as anything as 5 units and above, and anything less is considered the same class as single family. And the reason for that is that because it's treated differently by the banks. This is the short answer. So when you're buying a retail property, single family, duplex, fourplex, the value of that property is based on comparables, comps, right? So you could have a completely empty fourplex next to one that is completely occupied and maximizing its income. They're worth the same. If they're identical buildings, they're worth the exact same, because income doesn't really play into it. It might for you as an individual and how you bid, but in terms of the assessment, in terms of the appraisal, it really doesn't get factored in. Compare that to commercial real estate, commercial multifamily. It's really all that matters is the income of the property, right? So you could have 2 identical properties. If one is vacant, the other is fully operating. Of course, the fully operating one's going to be worth way more than the vacant property. So, and we'll dive into how that is calculated. But there's some big advantages to commercial, which is why I focus on it. And that is the big one. The other thing is when you're purchasing the property, because they're mostly focused on the property itself, that is what they're using to approve the loan. They're not looking at your personal income and credit score, because you're buying a $15, $20 million asset. Of course, it doesn't matter what your credit score is so much. What matters is that the property can pay the mortgage. So they're gonna value the property based on its income. Some other advantages is when you hit that 100, 150 unit range, you're achieving economies of scale. So those start to kick in. That's that you'll hear the term institutional grade kicked around. It's basically what that means is that it's a large enough property that an institution will be interested in buying it, and they're not going to buy a property that can't support on-site property management and dedicated maintenance personnel, right? So there's a lot of advantages to that with the economies of scale that you get. Things tend to operate cheaper, which increases your profit, which is good, right? So the answer for most people to access that type of investment are syndications. So what are syndications? So syndications are group investments. So it's a group of investors that pool their money to buy an asset that they otherwise wouldn't be able to purchase on their own. So typically you have a sponsor or a sponsorship team. It's often a team of individuals that team up. So for instance, the property we closed on earlier this year, it's a 232 unit multifamily property in Houston, Texas. We have a team of sponsors and we have different roles within that team. So, one of my primary roles during the acquisition process was to raise money. I was a capital raiser. So I brought in, $1.5 million for that property. Whereas someone else on the team, maybe their role was more focused on due diligence and getting the loan package together and that sort of thing. So it's common to have a team is my point. So they will find the property, analyze the property, manage the property, and the investors are just passive. So they're limited partners. So they put in an investment, $50,000, $100,000. They actually own a percentage of the underlying asset, which is a key distinction because if you're investing in something like a REIT, which a lot of people think is synonymous, but it's not. REITs, you're investing in the company that owns the real estate. You don't actually own a piece of the real estate. So you don't share a lot of the tax advantages and things like that. But in a syndication, you're actually buying a piece of the property. So, and you're actually generally investing in one property. So there's a lot of advantages. So that brings us to kind of now we're getting into the meat and potatoes of things on this presentation. So one of my favorite things about multifamily, and this is generally what makes it very attractive in general across the board, is, as I said, the value of the property is based on income, not comps. So how do we value them? All right, so it's very simple. What we do is we take the gross rents, the gross income of the property, we subtract the expenses, and that'll give us the NOI, the net operating income. So this is so you don't factor in your debt obligation into that because everyone's debt is different. Some people might borrow at 6%, others borrow at 3%. Some people might have mezzanine debt or private money, whatever. You want to compare apples to apples. So you just take the gross rents minus expenses, and that'll give you your net operating income. And then what you do is you divide that by the market cap. What's a cap rate? All right. So the cap rate is basically a reflection of the premium paid in that market. So if we look at a particular market, what we can do is to determine the market cap is we'll look at properties that have traded recently, say over the last 6 months or a year, and we can calculate what cap rate they traded at. And then kind of the average of all those is the market cap rate, right? So what you're doing is you're taking the net operating income and you're dividing it by the purchase price or the sales price, and that'll give you the cap rate that the property traded at, right? So net operating income divided by purchase price gives you cap rate. You average out the cap rates in a market. That's your general kind of market cap rate. That's just kind of a guideline for what things are valued at in that property, right? Now, this is important for us. So if you think about a market like Dallas, for instance, has a lot of investor demand. It's a very popular city to invest in. Things might trade at like a 4 cap there. So meaning the lower the cap rate, the higher the value of the property, right? Whereas if you're looking at somewhere like Detroit, where most investors are probably avoiding that market, maybe they'll trade at an 8 cap. So lower the cap rate, higher the value, higher the cap rate, lower the value. So the technique, or really the ideal, is you want to buy a property at a high cap rate, sell it at a low cap rate, right? So this is the exception to the rule of never buy high, sell low, right? So it's the opposite with cap rates. Yeah, so right now the average around the country is probably like a 5 cap or something. So cap rates have really compressed over the last decade because demand is so high. But this is really important concept to understand because we can use it to demonstrate how we can leverage this to consistently and predictively make money, a lot of money. So let's take a look at this. I've got this good example queued up. In a 200 unit complex, management is able to raise rents by $25 a door. The net effect of that is that the value of the property goes up by $1 million just from that small rent bump, right? And if you think about right now, figure someone's renting an apartment for $1,000, $1,200. What's $25 to them? They're probably not even going to bat an eye. Most people aren't going to move out over a $25 increase, right? So you can almost always do that every year. So how does the math work out? We take 200 units times $25 a month times 12 months will give us the total increase in income over the year. And we divide that by the market cap rate. So in this case, we'll use 6% for the example, and that gives us $1 million. So we can very predictably look out over 5-10 years and say, okay, if we can get our net operating income to increase by X amount, then our value of our building will increase by Y amount, which will give us our new sales price, projected sales price, right? So, obviously there's some other factors, some variables at play here that you don't have control over. But if you're conservative with this, so, the idea is to not assume you're going to have a low cap rate on exit. You always assume the cap rates are going to expand a little bit by the time you sell, but you can use this to very predictably determine how much money you're going to make on a property and really move the needle on the value of a property. So it makes it a very attractive investment for that reason, because you have control over the value and those values are incredibly resilient. So let's talk about resiliency for a second. So we just went through a global pandemic, something we haven't experienced as a planet for 100 years, right? But overall, multifamily performed extraordinarily. Rent collections were very stable. So this is from the National Multifamily Housing Council. So when COVID hit, they started putting out this rent payment tracker, and it tracks about just under 12 million apartments, what their rent collections are. So this is the full month results. So if you just look at, and this has by month going back 2 or 3 years, so showing pre-pandemic levels and then the levels for this year, you can see there's been a nominal decrease in collections, but generally pretty stable. And if you look at June in particular, you're talking 96% in 2019 versus 95.6%. So basically no change. That's nominal. It barely registers, barely moves the needle. So overall, the resiliency of multifamily makes it very attractive, right? It's a very safe place to be. Leverage. Another reason to love real estate is the incredible opportunity to leverage your investment. So that's going to boost your return. You can buy $1 million asset for a fraction of the cost out of pocket. With a couple $100,000, you could buy $1 million property. You're only out $200,000, but you get the full benefits of $1 million asset, the depreciation, the cash flow, everything that comes with it, right? So this is very beneficial for investors, especially if you're doing long-term investing. You'll also benefit from principal pay down, and it helps with hedging against inflation because you're paying down a mortgage with devalued dollars, right? So if you think about it, if you have a fixed rate long-term debt, this is something that drives me nuts. When you see people advocating paying off their mortgage early, it's one of the dumbest financial things you can do. So if you're doing that, just stop right now, please. And here's why. If your mortgage payment is $1,000 a month, would you rather pay $1,000 a month in today's dollars or $1,000 in 10 years from now dollars? Those dollars are going to be worth a lot less. The buying power of that $1,000 is going to be significantly diminished, right? Because of inflation, which right now is sky high. So you don't want to pay down early. You want to pay the minimum payment and then reinvest that money elsewhere. Let the bank collect that devalued, because now that mortgage is just being devalued. It works in your favor. Another big benefit of leverage is that you get the bank to do they're going to perform their own independent underwriting. So it's an added layer of protection for the investors and the buyers to protect themselves from overpaying, right? So, hey, sometimes people make mistakes and they miss things, and the lender might catch something and say, no, this property isn't worth this. And, it's just an added layer of protection. Let's talk about building classes. So there's different classes within multifamily that you hear talked about. So Class A is going to be your luxury units, your more affluent tenant base. You're going to have newer buildings with nicer amenities and finishes. And it's just going to be your upscale new construction buildings. And that's what your institutional buyers are going to be most interested in, is those Class A properties. There are downsides. Sometimes the cash flow is less. Often they're maybe an appreciation play more so than a cash flow play. And when things are tough, they may take a bigger hit. So Class A took a decent hit during the pandemic, is they had to start offering concessions and free rent and things like that. So then there's a step below that, which is Class B. So this is often kind of considered the Goldilocks zone for rents and tenant base, because you still have really strong rental rates. There's still high quality apartments. So you get a high quality tenant. They're just maybe a slightly older vintage, maybe some 80s or 90s construction that just needs some light renovation, something like that. But there's still going to be good finishes and good amenities. They may still have pools and a gym or something. But maybe they have a better balance between cash flow and appreciation compared to your Class A's. And then your Class C, this is going to be your workforce housing, your blue collar housing. So it's generally lower rents, maybe a bit more management intensive. It's going to be an older vintage with a more deferred maintenance often, but that could be opportunity. I think especially in the last 5 years or so, Class C has really been as competitive as Class B often in terms of cap rates, just because people are clamoring to buy real estate. Historically, there's going to be better cash flow, but maybe less appreciation. Maybe it's not as nice of an area or something, but you can still make a lot of money. What's not on the slide is your Class D properties. So this is more of your war zone properties. That tends to be a niche that people focus on, and they can do very well and make a lot of money, but they tend to specialize in that. You don't see a lot of people that are buying Class B properties go out and buy a Class D, because it's a specialty. It takes a different skill set. Let's talk downsides. It's not all sunshine and rainbows out there, right? There are downsides. So one of the downsides to real estate is it's a liquid. That's a fact. So unlike say a stock, you can't sell it on a whim. It takes time. You've got to prepare for that, and you've got to plan for that. It is a liquid. You can't just get out, and you're generally going to work around the market for when you get out, right? You're not going to have a set in stone timeline. It's not a short-term play. It's a long-term play. You just got to remember that. And when it comes to syndication specifically, usually you're going to see like a 2 to 7 year time frame. Most of them kind of will pitch on or target a 5-year timeline. 2 years would be like a quick flip, about how long it takes to flip a multifamily property. Typically, you're going to see maybe 5 years, sometimes 10. Some might ask, well, why don't you just hold this property for forever? It's cash flowing, it's making money. Why would you ever sell it? There's a lot of reasons, but one is to capture the value that you've created. So if you buy a $5 million property and you boost the income and you renovate it, now it's worth $8 million. Well, you have $3 million in equity that is maybe not going to work for you in there, right? So you can sell it, capture that value, and replace it somewhere else. And then another advantage to getting into a new property is you're starting a new depreciation schedule. It's right now, especially, we have something called bonus depreciation, which allows you to depreciate the first 15 years in year one, which is a huge amount of depreciation. That's a big write-off. So a lot of people find that very advantageous. It's a good way to limit your tax burden when you exit a property, just roll into another property. And now you can start the process all over again, and you're buying a $8 or $10 million property that you can turn into a $12 or $15 million property, right? So there's a lot of reasons to sell. But some people like to do more of a long-term hold. You can still get cash out through a refinance, which is non-taxable, which is great. Other downsides, codependence. So yeah, there's going to be other players involved. So if you're just looking to kind of work by yourself and not depend on property managers or contractors or whatever, then commercial real estate probably isn't for you, because there is a lot of players and there's a lot of specialties that you need to rely on. So you got to learn to be a team player. 1031s can be challenging. They're not impossible in a syndication, but generally they're rare. I've seen them, but they're rare because it does take a lot more legal work and coordination and things like that. And lenders don't like it easy either because of the way you structure the deal often. So sometimes that's a non-starter doing the 1031, but I have heard of it. You can do ticks and different things. All right, so look at some of the macro trends that are driving the industry. So since 2010, looking over the past decade, and some of this data is a little bit out of date, but to be honest, not much has changed. Well, the last year, things have only gotten better for real estate investors. The property prices have gone sky high and rents along with it. So this is looking 2010 to 2019. You can see that rents went up by 36% and home prices went up by 31%. So typically, as home prices go up, rents are going to follow. So people are getting priced out of the housing market. They're stuck renting. Usually the two are going to be correlated. And I can just say anecdotally, even in the last year, my properties in South Dakota have increased rents by, I had some vacancies last month, 25%. In South Dakota, 25% rent bump. That's unheard of. So the last year, things have just exploded. So that's just good long-term. Housing going up is good for people that own rental property because it helps you boost your rent. Okay. Also seeing increases in number of high earning renters. So households earning more than 150,000 have gone up by 157% in the renter class in the last decade. That's a very positive trend. The number of renters. So in the last decade, we've added about 10 million people to the renter pool, expected to add another 10 million people to the rental pool over the next decade. So the demand is not going anywhere. And if we look at apartment deliveries over the last decade, you're looking at, I don't know, somewhere, this is like over the last decade, I think it tallies up to about 2.4 million. So that's not going to cut it when we're adding 10 million people, right, of new renters. So the bottom line is, especially with the current environment of building costs, I mean, a piece of plywood is worth its weight in gold right now. Building costs have exploded over the past year. There's been some relief in the last month in things like lumber, I know, but still costs are exploding, which is going to make it even harder for projects to pencil out, which is probably going to put a squeeze on the number of apartment deliveries. So the bottom line is we're just not building enough to meet demand. We have a housing shortage in this country right now, and it's only going to get worse. And if that's the case, you want to be the person holding the assets, in my opinion. So, all right, let's finish off with the top benefits of multifamily. So I call this the multifamily six-pack. This is the top six. So number one, cash flow. Cash is king. It's a cash flow producing asset. This is unlike the stock market, unless, well, I guess you could have dividend stocks. What do they pay? 2-3%? It's a joke. You're not even keeping up with inflation. You're losing money. So cash flow. Typically in a syndication, you're going to receive quarterly distributions for your share of the profits that come in. And often these could be double-digit returns, probably not in the first year or two, but, you know, it's certainly not unheard of to see in years, 4, 5, 6, cash flow eclipsing 10, 12%. So cash flow, I think, is probably the best benefit to investing in real estate because you're able to get cash from your investments without touching your principal. So your principal is still in the property. It's still growing. It's appreciating. It's safe. It's in a real hard asset that you don't have to touch to get money out. So, me personally, and I think for a lot of people out there that start to realize the power of this, is that if you just own a significant amount of cash flowing real estate, you never have to cash out and you can live off that in retirement. If you're bringing in 6 figures in cash flow, you never need to touch your principal. Whereas if all your money is in the stock market and the stock market has a down year and you're cashing out your principal to live off of, well, you're just making it harder to dig out of that down year. And that's how it's a slippery slope, and that's how people get into trouble, because if they're not performing in real estate and keeping up with their withdrawal rate, they're just eating into that principal. And sometimes that's fine, but I would imagine it gets very uncomfortable when you're down to your last few $100,000 and you're still in good health, right? So I don't want to be in that situation, and I don't want you to be in that situation. But if you have cash flow coming in, it's a non-issue, right? Appreciation. This is you can make a lot of money just off of market appreciation. Inflation is going to help drive that as well. But there's also forced appreciation, which is what we talked about, where you're fixing up the property, you're increasing rents, you're increasing that NOI. That's going to increase the value of the building. That's forced appreciation. And we've seen even those small increases in NOI can yield outsized, significant increases in value. Number 3, professional management. So it's not like hiring a property manager that manages a handful of duplexes. It's going to be a much more sophisticated level of management. They'll handle the day-to-day so that you or the sponsorship can focus on the bigger picture, create some passivity, but focus on scalability and really the asset management piece of it, which is coming up with the business plan and the strategy and directing property management how to achieve that strategy through the day-to-day management, right? But you're not dealing with broken toilets and complaining tenants, right? You have people at the property that deal with that. You have dedicated maintenance to deal with day-to-day maintenance issues, and things just tend to run a lot smoother. Already said, inflation and protection. So real asset values tend to increase with inflation. So it's a great store of value. People right now are fleeing towards real estate, Bitcoin, gold. So real assets that have inflation protection, they'll hedge against it. And, the Fed just continues to print money. And I have cash value will decline. It has declined. Cash value has declined already. Your pricing power is diminished since a year ago, significantly. Tax advantages. So, we could talk a full hour about the tax advantages of real estate. Big one is depreciation is going to offset your tax burden. You have the ability to write off mortgage interest. There's opportunity zones. An opportunity zone is a census tract that's been designated as an opportunity zone. And what that means is if you invest there, so let's say you have, like a lot of people in Silicon Valley, they have stock options that they're tied into. And historically, a lot of them probably felt trapped into not cashing out because they didn't want to pay the tax burden on it. Well, what the opportunity zone allows them to do is cash out their stocks, put that money into an opportunity zone investment, and they can defer the taxes on that initial capital gain up to 10 years. And I think they even relieve like up to 15% of the tax burden. And then any profits that you make from the investment itself within the opportunity zone, you don't pay any taxes on. So it can be very lucrative if done right. They're just very hard to find. It's tough to qualify because you need to invest. If you pay $1 million for a property, you got to invest $1 million into the property. So it really only works for development. So it's hard to find and it's hard to justify often. A lot of the opportunity zones are kind of Class D neighborhoods. So it's tough to justify those. And finally, economies of scale. So we talked about this. Your impact of vacancies is limited because now you're talking about 100, 200 units. You're always going to have some vacancies, but when you're in a duplex and somebody moves out, that's 50% vacancy. When you're in a 200 unit complex, you're going to ride pretty consistently in the 90s, 90% occupancy, 95% occupancy. That's considered fully occupied, right? Because you're always going to have some transient movement, but it's going to be much more consistent and stable. And then, of course, there's labor efficiencies. Like I said, having on-site management, being able to purchase materials at scale makes things a lot cheaper as well. All right, and finally, the life cycle of a deal. So just from a very broad perspective, this is another one we could talk in detail, but well, there's probably one step that's not in here, which is education. So learning about multifamily is where most people are going to start. But of course, once you've learned about it, then you're looking at the acquisition phase. So this is looking to acquire a property, talking to brokers, talking to other investors and property owners, and looking for deals, looking for opportunities. So when you find an opportunity that looks appealing, then you're going into the due diligence period and probably making an offer at that point. So there's a lot of due diligence that occurs prior to the offer being made. But there's probably even more due diligence that occurs after an offer has been accepted. So going through all the books, going through all the financials to verify all your assumptions, verifying the property taxes, the expenses, everything with a fine-tooth comb. And it's extensive. And actually, with the property we acquired in Houston, we had a third party that conducted a lot of that due diligence. They had a team of people that this is what they do. They went in and they audit every single lease. They audit the financials to figure out what is actually happening. You're looking at bank statements and bills to make sure that you know what you're getting into. So there's a lot of work that is involved in that. It takes a lot of time and a lot of effort. And then once you close on the property, then you go into the operations phase. This is where you're improving the property, you're renovating units, you're increasing rent. Maybe you're doing some amenity adds, adding maybe a dog park or a playground or a pool even to improve the property so you can charge more rent. You're going to maximize your NOI. The whole goal during this period is to maximize your NOI, get the property stabilized and running smoothly and efficiently, firing all cylinders, so you can eventually go into the disposition phase, which is when you put the property on the market to sell it and collect your profit. All right. So what did we learn? We talked about why you need to invest in real estate and seek outsized returns, because earning 8-10% just isn't going to cut it, especially in today's environment where we're living so much longer throughout retirement. And that really is the greatest risk to investors, is not taking that leap and getting out of the mutual funds, out of the index funds, into higher performing, higher yielding asset classes like commercial real estate. So we did an overview on some of the fundamentals of real estate, how we value properties, how we add value to properties, and what is some of the macro level trends that are driving demand long term that makes us confident it's going to continue to be a great place to park our money. Some of the top benefits of multifamily, namely cash flow, which is where you're going to get a good chunk of your profits and be able to use it or save it and reinvest it if you want. But if you're reinvesting your cash flow, then you're just adding to the compounding effect of compound interest and boosting your overall returns. And a quick look at the life cycle of a deal. So that's going to do it. That is the form of purchase of the webinar. I'll show you guys. This is just a project that we have live right now in Loveland, Colorado. My partner is the developer with Apogee Development out in Loveland, and we're building an 8,400 square foot office condos, which are currently for sale. We're probably about 6 weeks out from completing construction on that. So we've gone vertical. We've got a lot of the mechanicals done. We're waiting. I think windows go in this week and then stucco. So we're moving along toward the goal line. But even though this is a multifamily focused presentation, if someone is looking for a triple net asset, this would be, I think, a great asset to purchase. We're selling this for $1.8 million. And I've done some math I could share with you if someone's interested in a triple net investment, but this will cash flow and earn a really solid return in a great asset class that is considered a safe haven for the next decade, especially with the way medical is blowing up right now. I think it's a really great place to be. So if you're interested in that, feel free to reach out. If you guys are not familiar with the Mach 1 report, this is a quarterly report now that I put out that goes over some of the trends in the economy, kind of gives an overview of what's going on with the jobs market, the economy as a whole, and then a dive into the multifamily and real estate markets as well. Sometimes I'll maybe do a spotlight on an asset class like medical or something like that, industrial, to just kind of show, hey, what's the trends, what's the outlook for these asset classes. So the Q2 report should be coming out probably in the next couple weeks. Usually I'm just a little bit behind because I got to wait for a lot of the data to drop, and then, it takes me a bit to put it together. So that should be coming out in the next few weeks. If you have any questions for me, don't hesitate to reach out. Here's my contact info. You can email me, keegan@mach1equity.com. You can visit mach1equity.com and fill out an investor questionnaire, and that'll actually allow you to provide a little bit of information about yourself, and then set up a call with me directly as well, so we can schedule that out if you're looking to talk about investments